A quarter point cut now would be expected to slightly lower borrowing costs. Home buyers could lock in modestly lower mortgage payments, businesses could refinance or take out cheaper loans, and some consumer debt burdens would ease. Lower borrowing costs are intended to stoke demand. Cheaper credit encourages consumers to spend and businesses to expand. This, in turn, can slow or reverse a job slowdown. Fed officials' goal is to engineer a soft landing, guiding the economy so that inflation returns toward 2% without causing a recession. As one Reuters commentary notes, the Fed hopes to keep the economy like that, avoiding recession, by cutting rates, which makes it less expensive for businesses and households to borrow and therefore spend more freely. In other words, rate cuts are aimed at bolstering hiring and spending just enough to counter the cooling trends in the job market. However, it is important to note something. Rate cuts have varied effects depending on broader conditions. Historically, when the Fed cut rates during ongoing growth, non-recession, markets often responded positively.